So, is the worst over for the banks? Brian Becker joins us. He's the executive director of the Answer Coalition. Brian, thank you for joining us from San Francisco. You know, I have very fond memories of San Francisco. We had the tech boom, but we never, I think, expected this banking epicenter to be in San Francisco, but here we are. You know, first, let me get your reaction. You know, for somebody who lives in that area, there must be a very big local impact, and I think there's got to be some shock there too, right?
Well, let's just put it into perspective. Of course, the San Francisco Bay Area, Northern California, is very vulnerable. It's not just the people who work there. It's not simply the surrounding environment. It's the housing market there. I mean, it's all very deeply interconnected in Northern California. So the shock waves will undoubtedly continue. At the same time, there are massive layoffs going on from all the tech companies and from social media sites. So when you talk about the dot-com boom, there was also the dot-com bubble burst 20 years ago. And then we had the 2008 financial housing bubble burst. And then we had another major crisis with which was attributed to COVID in 2020. In each case, there's this blame game. You have the FDIC, the Treasury Department, the Federal Reserve, the members of the House, or in today's hearings, the Senate, everyone seeking to blame someone else. But if you have a periodic crisis that bring the entire banking system and thus the entire economy that affects the lives of tens of millions of people, and it happens routinely 3 times or 4 times just in the last 20 years, and the big issue now is that could the contagion spread? It's not about mismanagement per se, even though there's undoubtedly mismanagement. It's not only about the inability of members of Congress to impose strict regulations, even though that's also true. We have a sick system, and in each and every case, when the banks fail, unlike the savings and loan crisis in 1989 and 1990, right, where there were 10,000 criminal referrals, there's no accountability here.
Brian, first of all, let me correct our viewers here. You're joining us from Washington, D.C. You know, one of the things that was brought up in today's hearing was the fact that it was a very clear question: should there have been more regulation? I think the answer was yes. At the same time, is management to blame? And the vast majority of people believe that management certainly has a responsibility for all this. But let me just give you one interesting statistic. Washington Mutual, which I'm sure you remember, lost nearly $8 billion over 4 months. In this most recent crisis, Silicon Valley Bank lost nearly $40 billion in 4 hours. Times are different now. People have access or the ability to move money so quickly that the regulators probably don't have time to even react to it, let alone the management of the bank. I mean, I do think we live in a very different technological time where maybe it's way ahead of where regulators can control or fix things.
Well, yes, that's undoubtedly a factor. I mean, people can withdraw money in an instant. Peter Thiel, in the case of SVB Bank, said he was taking his money out. He's a billionaire. He's an influencer, and immediately people lost confidence. And as you said, billions can be withdrawn on people's phone in a matter of a couple hours, 4 hours. So yes, the new technology is the ability of people to run on the banks in a different way, not having to actually go to the banks. That's undoubtedly a factor here. But the other point I was making is that we have system failures. And so it's not simply a problem of regulation, even though I agree with you, the technology has changed the game in many ways.
What specifically, when you say a system failure, what exactly, if you could fix something, what would that be?
I think we have a situation where you see that the banks have become dominant in the economy generally. Glass-Steagall was repealed in 1999. That allowed commercial and investment banks to come together. That meant investments become ever more risky. There was a deliberate decision to take away the conservative regulatory apparatus that was developed in 1933 when all of the banks collapsed in America. And so the Congress has its fair share of responsibility for this. And that's why we see repeated crises, because the bottom line is, can you maximize profits? That's the bottom line. And that's all that really matters. And so people are taking untoward risk. And again, ultimately, the government says, the Federal Reserve says, oh, it won't be on taxpayers.
Well, hang on. To be fair, Silicon Valley Bank lost money on long-term Treasury bonds, which under any normal situation people would view as considerably safe. That said, let's go with your point. Banks have depositors like me who take money and they loan it out to business people or investors who want to take additional risk. If it wasn't for that perhaps system, startups wouldn't get funding, private equity firms wouldn't get funding, factories wouldn't get funding to create jobs. I mean, I'm just simply playing devil's advocate, but you need to have some level of risk out there. Otherwise, nobody would invest in the future and create jobs, would they not?
Well, it sort of takes the venture out of venture capitalism when the government's always backstopping every failure, isn't it? I mean, we have to also think about what kind of environment that creates. There's always an advocacy for venture and risk, but bottom line, the government's always there to bail out the banks. And again, people in 2008, 9 million families went into foreclosure. They didn't get bailed out. 3 million actually lost their homes. So there is a basic social cost for some parts of the population that doesn't have venture capital, that's not privileged, and they're the ones who bear the brunt. And this is what will happen if there's a bank-induced financial crisis. One more quick point. You're right, those were conservative investments by SVB Bank, but what caused their conservative investments to be so sort of suddenly risky was because the Federal Reserve was then increasing interest rates to curtail inflation.
Right.
So each solution to one problem is the cause for another problem. That's another evidence, I would say, another real indicator of a system failure when the solutions are really the cause of even larger problems.
I will certainly agree with you that there are a number of unintended consequences, and a lot of different parties bear a ton of responsibility for what happened, because what happened should not have happened. Brian, I really appreciate your time on this and your analysis. Thank you.
Thank you. Thank you.